each method. So actually we have talked about absorption costing and variable costing, but we will get a closer look at each method during these sessions. So three key concepts. So both formats include product and period cost, but cost classifications are defined differently. So variable costing income statements are grounded in the contribution format and categorize expenses based on cost behavior. So do you remember variable costing? So in the product cost, we include only variable costs. And statements, variable costing income statements based on contribution format. So I hope you remember what contribution is. And both methods, net operating incomes, often differ because of the fact that methods account for fixed manufacturing overhead differently. So net operating income is different, will be different on the variable costing system and on the absorption costing. And this is because fixed manufacturing overheads are accounted for differently, and we will look. So overview of variable costing. So variable costing, do you remember? In product cost, we include only variable costs. Direct materials, it is variable. Direct labor, variable cost, and variable manufacturing overhead. So direct materials, direct labor, why they are variable costs? Because the more units we produce, the more materials we need. Direct labor also, the more units we produce, the more direct labor or workers or direct laborers we need. So variable costs usually vary with the number of units produced or increase with the number of units produced. If we increase the number of units, variable costs also increase. If we decrease the number of units produced, variable costs also decrease. So they vary or change level of activity. So in variable costing, in product cost, we include only direct material, direct labor, and variable manufacturing overhead. It's variable manufacturing overhead. In period costs, we include fixed manufacturing overhead, variable selling and administrative, and fixed selling and administrative. So just keep in mind that selling and administrative expenses also may be variable and fixed. And selling administrative expenses have been broken down here into variable and fixed portions. Okay, so if you noticed, in variable costing, we do not include fixed manufacturing overheads into the product cost. We do not include. Let's look at absorption costing. Look at the product cost. So what do we include into the product costs? What do we usually include? Direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So as you see in absorption costing, the total amount of manufacturing overheads, variable and fixed, are included into the product costs. Period costs, variable selling and administrative. So we include, in period costs, We include variable selling and administrative and fixed selling and administrative expenses. Okay, so notice the difference, students. Have you noticed the difference in variable costing and the difference between absorption costing?
Yes.
So if you, let's look at this diagram. I will just try to open from the book. So can you see this exhibit 7.1?
Yes.
So variable costing versus absorption costing. So we have manufacturing costs. To remember, raw materials, we have direct labor, variable manufacturing, fixed manufacturing, and we have non-manufacturing costs. So in absorption costing, so this costs from raw materials inventory account. Do you remember direct materials go into the work in process account? So we open work in process account. Direct materials are included into the work in process account. So here into the work in process account, we gather all costs, we collect all costs in order to calculate the cost of goods manufactured. So direct materials goes to work in process account. Then on the direct labor also goes to work in process account. On the absorption costing, variable manufacturing overhead also goes to work in process account, and fixed manufacturing overhead will be included into the work in process account. So here on the debit side of the work in process account, so we collect all costs. Okay, and on the credit side, we have what? The cost of goods manufactured, goods completed. So what is the cost of goods completed? So we have here the cost of goods manufactured. Okay, and this cost of goods manufactured then will be transferred to finished goods inventory. So finished goods will be transferred to this account, finished goods account. And they will be awaiting until company sells them. When company sells finished goods, then the cost of these finished goods will be shown into the cost of goods sold account. And this account goes to income statement. So will be included into the income statement. Okay, so what I want to highlight here that under absorption costing, direct material, direct labor, variable manufacturing, and fixed manufacturing overheads all goes to work in process account. Under absorption cost, so all costs are included. All manufacturing costs, remember only manufacturing costs, not the period costs. Okay, on the variable costing system, what happens on the variable costing system? We include raw materials into the work in process account, direct labor, and variable manufacturing overheads only. What happens with fixed manufacturing? Fixed manufacturing goes to directly, we say, fixed manufacturing overheads are directly expensed to income statement. So we just include them in the period expenses. So we expense them into income statement. We do not include them into work in process account. We do not include this variable fixed manufacturing overhead into the cost of goods manufactured. So we expense them directly into income statement, and also non-manufacturing costs such as selling and administrative, we also expense directly to period expenses. Expense them to income statement. We show them as period costs. So this is variable versus absorption costing. So have you got the point? Have you got the difference? It is vital, I mean, very important and vital to know which costs are included on the variable costing system and which of them are included under absorption costing. Okay, now let's move on with our presentation. Okay, and now concept check. Which method will produce the highest values for work in process and finished goods inventories? What do you think? Absorption costing, variable costing, they produce the same values for these inventories, or it depends on something? Which method will produce the highest value for work in process and finished? Okay, let's go back to our diagram exhibit. So what do you think? The cost of goods manufactured will be higher. The value, I mean, in dollars, the value of cost of goods manufactured will be higher under which of the methods, absorption costing method or variable costing method? What do you think? Salma, what do you think? Under which method the cost of goods manufactured will be higher?
Maybe absorption costing, Prof.
Yes, exactly. Very good. You are a clever girl. Under absorption costing, the value of cost of goods manufactured will be higher. Why? Because we include fixed manufacturing overheads into the work in process account. So on these accounts, we collect all costs, and then we know the cost of each unit produced, right? So here, on the absorption costing, of course, the value of cost of goods manufactured will be higher. On the variable costing, we do not include these fixed manufacturing overheads into the work in process. We simply expense these costs directly to income statement. And that's why on the variable costing system, the value of goods manufactured will be lower. Okay, now let's again move to, so which answer is correct?
A, Miss.
A, yes. Absorption on the absorption costing. Okay, now let's look at the example. Unit cost computation. How to calculate unit cost? How a company produces a single product with the following information available. So we have information. We have this information. Number of units produced annually. So each year, 25,000 units company produces. And direct materials, variable cost per unit, direct materials, direct labor, and variable manufacturing overhead. So they make up a total $10. Okay, and then you see that variable selling and administrative expenses also have been separated. Variable selling and administrative expenses, $3 per unit. Fixed cost per year. So this is manufacturing overheads total, manufacturing overhead fixed, and we have here fixed selling and administrative expenses, 100,000. Let's look now what is a unit product cost under each method. Look at the absorption costing method. So what we include in the unit product cost: direct material, direct labor, variable manufacturing overhead, $10, and plus fixed manufacturing overhead per unit. So what is the total amount of fixed manufacturing overhead? 150,000. It's fixed. What is the fixed manufacturing overhead per unit? So what we need to do? $150,000. We need to divide by 25,000 units. And if we divide, fixed manufacturing overhead per unit is $6. And under absorption costing, unit product cost $16. Under variable costing, so we include only in product cost, we only include variable cost. We do not include fixed manufacturing per unit, fixed manufacturing overhead per unit, and unit product cost under variable costing equals to $10. So you see the difference here on the absorption and a variable costing system. Okay, got it? Remember, preparing for Huawei company. 20,000 units was sold during the year at a price of $30 each. So you see the company actually produces each year or annually 25,000 units. So we will this example will be based on this information. So number of units produced 25. But company sells 20,000 units was sold during the year at a price of $30 each. There is no beginning inventory. So company had no any inventory left from the previous period. If company has some inventory or goods which were produced last year and a number of goods from the last year, if there is some number of units from the last year, then it becomes beginning inventory for the next year. But we are told that there is no beginning inventory. And now let's compute net operating income using both systems, absorption and variable costing. Okay, so let's calculate. Sales revenue, first of all, sales revenue. So company sold 20,000 units at the price of $30 each. If we multiply 20,000 units by $30, we receive sales revenue. It is revenue of the company, 600,000. Now let's subtract variable cost. So we are calculating under variable costing method, variable costing contribution format income statement. So from sales revenue, we subtract all variable costs only. So we subtract what? Variable cost of goods sold. 20,000 we multiply by 10. Why it is 10? This is a unit product cost, the cost per unit. Okay, this $10, how do we know that it is $10? Okay, we base on this information. Do you remember variable cost per unit? Unit product cost under variable costing system is $10. Unit product cost $10. So the cost of each unit $10. If we multiply by 20,000 units sold, so this will be cost of goods sold 200,000. Then we subtract variable selling and administrative expenses. So how many units a company sold? 20,000. We multiply by 3. Okay, look at this. Variable selling and administrative expenses per unit is $3. So this total variable selling and administrative depends on the number of units sold. So that's why if company sells 20,000, so we multiply 20,000 units, we multiply by $3. Variable selling administrative per unit is $3. So it is 60,000. And total variable expenses. Total variable expenses $260,000. Okay, total do you remember contribution? Sales minus total variable costs, or selling price minus variable cost per unit. Okay, sales minus total variable cost will get contribution margin. Contribution margin 340,000. And then from contribution margin, we subtract fixed manufacturing 150,000, fixed selling and administrative. All fixed costs then we subtract from contribution margin. And then we get what? Net operating income. So it is 90,000. So why it's important for managers to use this variable costing contribution format income statement, because they need to know which costs, first of all, they highlight variable costs, and they see that variable cost increase with the number of units sold, and they get contribution margin. And you see that the total amount of fixed manufacturing overheads is included into the income statement in the fixed expenses. So company must generate contribution margin, right, enough to fully cover all fixed expenses, manufactured and fixed selling, to be truly profitable. So if company is able to generate contribution margin which covers all fixed costs and receive some net operating income, So it actually shows that the company is truly profitable. Okay, just keep in mind, remember, net operating income 90,000. It is under variable costing system. So contribution format income statement. Okay, now let's look at absorption costing. So just keep in mind, in contribution format income statement, sales less all variable costs, then contribution margin minus all fixed costs. Let's look at absorption costing income statement. So our sales revenue is the same, 600,000. Cost of goods sold is different. So how many units company sold? 20,000. We multiply now not by 10, but by $16. Why $16? Let's go back to this table. Under absorption costing, unit product cost equals $16. Why it is 16? Because in unit product cost, we included fixed manufacturing overhead per unit $6. So that's why our cost of goods sold, unit product cost under absorption costing higher than under variable costing. Okay, so what we do, 20,000 units, which we multiply by $16, and cost of goods sold 320,000. If we subtract this amount from sales revenue, gross margin, we receive not contribution, but we call that gross margin under absorption costing. And then gross margin, we subtract selling and administrative expenses, variable and fixed. Just period costs, we subtract period costs. So variable selling and administrative 20,000 multiplied by 3. So we know that is, we take from this, we derive this $3 from these tables. Variable selling and administrative, it's variable. So depends on the number of units sold. Okay, $3. That's why we multiply 20,000 by $3. It's variable part of selling and administrative expenses, and also we subtract fixed cost. So net operating income equal 120,000. And why it is, if you notice that under absorption costing, a net operating income is higher, 120,000, then it is under variable costing. So under variable costing, net operating income 90,000. Under absorption, it's 120. Why this difference occurs? It occurs because fixed manufacturing overhead deferred in inventory is 5,000 units multiplied by 6, 30,000. Okay, how do we know 5,000 units? Let's again recall that company produces 25,000 units each year, and company sold 20,000 units. So how many units have been left in inventory? This is a question.
5,000.
5,000, right? And under absorption costing, these 5,000 units include what? Includes these 5,000 units contain fixed manufacturing overhead per unit. So each unit keeps or contains $6 of fixed manufacturing overhead, right? Okay, and that's why the portion of fixed manufacturing overhead resides in the inventory. So this portion of fixed manufacturing overhead is not included in the income statement, but it resides in the inventory, still in the inventory. Because under absorption, we include these costs into the unit product, each unit. And as far as 5,000 units have not been sold, then portion of fixed manufacturing still deferred in inventory. So 5,000 units, if we multiply by 6, $30,000, right? So this $30,000 of fixed manufacturing overhead is kept in the inventory. And that's why you see that the cost of goods, and that's why you see that net operating income and the absorption costing is greater than on the variable. So what is the difference between 90,000 and 120,000? What is the difference here? Fabriante? Difference between 90,000 and 120,000. $30,000, the difference. And the $30,000 of fixed manufacturing overhead resides in the inventory, in the ending inventory. Okay, so as you see, so that's why there is a difference in net income. So depending on which method is being used by the managers, the net operating income will be different. Okay, now reconcile variable costing and absorption costing, net operating income, and explain why the two amounts differ. So under absorption costing, we have variable manufacturing overheads. Just so under absorption costing, we have what? Cost of goods sold, variable plus fixed manufacturing, and we have cost of goods sold 320. In ending inventory, we have 50,000 of variable manufacturing and 30,000 resides of fixed manufacturing overhead resides in ending inventory. Okay, what is the value of ending inventory? 80,000. Period costs. Okay, and the total, let's calculate total cost 250, fixed manufacturing overhead 150, and the total is 400,000. On the variable costing, so what we have? The cost of goods sold 200,000. We don't include fixed manufacturing overheads. So ending inventory also it only includes 50,000 of variable manufacturing, and in a period cost we subtract the full amount of fixed manufacturing expenses. We subtract the entire amount of fixed manufacturing overhead, right? And that's why if you see the total of variable manufacturing, the total 250, also fixed manufacturing, and the total amount of cost 400,000. So as you see, this 30,000 of fixed manufacturing is kept in ending inventory. And that's why, because of this 30,000, the net operating income is different, is actually higher, and the absorption costing, it is higher. It is greater by 30,000. Net operating income, I mean, is greater by 30,000. So how can we compare or reconcile the difference between two methods? Okay, if variable costing net operating income 90,000, if we add, for example, you are given a question where the net operating income under variable costing method is 90,000, and the beginning inventory is 0 and the closing inventory is 5,000. Okay, and fixed manufacturing overhead per unit is $6. So calculate net operating income under absorption costing. So how you easily may calculate this? Variable costing net operating income 90,000 plus what is the amount of inventory, ending inventory? 5,000 units. We multiply by 6 fixed manufacturing overhead per unit, $6. This is fixed manufacturing overhead per unit. So it is 30 if we multiply. If we add this together, so then we will find net operating income under absorption costing method. How to calculate fixed manufacturing? I told you that total fixed manufacturing overhead we divide by the number of units produced. It is $6. Okay, are you getting me, students? Do you understand? Fabrianti, Salma?
Yes, miss.
Okay, so extended comparisons of income. So number of units produced, you see that number of units produced. Okay, we will have now year 2. So for year 2, now we have been given this following data. Number of units produced 25,000. Number of units sold 30,000. How come it can be 30 if Harvey only produces 25,000? Who can tell me? It's year 2 operations.
It's from the beginning inventory.
Yes, very good, because it has beginning inventory of 5,000, right? Do you remember from the previous year? So units in beginning inventory 5,000. Yes, 5 plus 25, 30. So that's why company was able to sell 30,000 units. Unit sales price $30. Variable cost per unit is direct labor, direct material, variable manufacturing make up total $10. Variable selling and administrative 3. We still know that fixed manufacturing per year, the total manufacturing fixed 150 and fixed selling and administrative expenses 100,000. Okay, and then again, under absorption costing. So what is the unit product cost? $16. Because of this $6 of fixed manufacturing overhead, which is included into the unit product cost. Under variable costing, we only include variable cost into the unit product cost. Okay. Okay, under variable costing. So what is the variable cost of goods sold? Now company sells not 20,000, now company sells 30,000 units. So what is the cost per unit? From this table, $10. So we multiply by $10, the cost of goods sold. And we include variable manufacturing costs only. Fixed manufacturing overhead 150,000. All fixed manufacturing overhead is expensed. So we must include the entire amount, 150,000, into the income statement. Okay, let's look at operating income. So sales, 30,000 units sold at $30 each. So we multiply, what is the sales revenue? $900,000. Then we subtract in variable costing, we subtract all variable costs. We subtract cost of goods sold, which is 30,000 multiplied by 10, $300,000, less variable selling and administrative. Now company sells 30,000, we multiply by 3. As you remember, variable selling and administrative, it is $3 per unit. So it's 90,000. Total variable expense 390. We subtract this amount from the sales revenue, 900,000. And what is contribution margin? 510,000. Then from contribution margin, we subtract all fixed costs. Fixed manufacturing, 150, and fixed selling and administrative. Okay, and what is a net operating income? 260,000. Okay, just remember this. Net operating income, 260,000. Let's calculate on the absorption costing now. So sales revenue is the same amount. Cost of goods sold is now different. 30,000 we now multiply by $16. Do you remember $6 here is fixed manufacturing overhead per unit? On the absorption costing, we include variable and fixed manufacturing overhead into the unit product cost. So we multiply, and the cost of goods sold 480,000. If we subtract, we receive gross margin. From gross margin, then we subtract selling and administrative, variable and fixed. And net operating income 230,000. Now you see that on the absorption costing system, net operating income is lower. Why it is lower now than on the variable? To think why it is now net operating income is lower on the absorption costing than on the variable costing system. What do you think? Compreende, Salma, Navita? Salma, why?
Because 30 units means 30,000.
Salma, because of connection, I cannot understand what you are telling. Because of what, Salma?
Is it because sales is 30,000 units?
So because of the fixed manufacturing overhead, do you remember 30,000 of fixed manufacturing overhead were riding in ending inventory. So this fixed manufacturing overhead of 30,000 comes the previous year, from first year. It was residing, it was like sitting in the inventory. Now when companies sold this inventory, 5,000 units, and each of these 5,000 units has $6 of manufacturing overhead, which comes from the previous period. Now company sells in the current year, in the year 2. So this decreases because of the 30,000. The net operating income 30,000 less on the absorption than $30,000 less on the absorption than on the variable costing. You see? Because the 30,000 which comes from year 1, now this 30,000 is included in the income statement of year 2. And of course, it decreases net operating income.
Okay, okay.
So got it, Salma? Okay, and let's look how we can make a reconciliation. If we know variable costing net operating income, 260,000, and if we know inventory, right? Multiply 5,000, we multiply by 6. So we subtract 30,000 from 260, and we can find absorption costing net operating income. And what have you noticed about these examples, in these examples? So just a very important point here. So in the first period, absorption costing profit was higher than variable costing. In the second period, absorption costing net operating income is lower than variable costing net operating income. And why it happens? The thing is that we must look at the inventory, whether inventory increases or decreases. So let's look at this table, comparative income effect. When units produced equal to units sold, so everything that company produced during the year, it's sold out. Let's say 25,000 units company produces, and if it sells 25,000 units, so there is no change in inventory. Inventory start beginning inventory and closing inventory. There will be no change. So change is 0, equals to 0. Then absorption costing net operating income will equal to variable costing net operating income. If units produced higher than units sold, so units produced higher than units sold, when company produces 25,000 units and sells 20,000, beginning inventory was 0. What is the ending inventory? If it produces 25,000, but sold 20,000. So what is the ending inventory? Amount of ending in 5,000. It means that inventory increases. Beginning 0, ending 5,000. What happens to inventory? Inventory increases, ending inventory, right? So there is an increase in inventory because ending is higher than beginning. If it happens, if inventory increases, then absorption costing profit will be higher than variable costing profit. When it is the opposite, units produced less than units sold. So units produced 25,000, units sold 30,000. So what happens to inventory? In year 2, beginning inventory was 5,000, but ending inventory now 0. Because units produced less than units sold. So beginning was 5,000, ending inventory 0. So what happens to inventory?
The inventory is decreasing.
Decreases. Yes, when inventory decreases, so in this case, absorption costing profit will be lower than variable costing profit. Why? Because that inventory, 5,000, that was in the beginning, this inventory comes from the previous period. And it has, these 5,000 units have manufacturing overheads included. Do you remember $6 each unit has $6 of manufacturing overheads, fixed manufacturing overheads. And this fixed manufacturing overheads also comes from the previous period. And when these 5,000 units sold in the current period, in year 2, so of course, this fixed manufacturing overheads of 30,000 will be decreasing net operating income. So remember, when inventory increases, absorption costing profit higher than variable costing. When inventory decreases, absorption costing profit less than variable costing profit. So you need to pay a great attention to the change in inventory. Okay, now enabling CVP analysis. Okay, when variable costing categorizes cost as variable and fixed, so it is much easier to use this income statement format for CVP analysis. So do you remember CVP analysis? So this format, contribution format, is suitable for CVP analysis. And because absorption assigns fixed manufacturing overhead costs to unit produced, a portion of fixed, such as $6 per unit for Harvey Company, a portion of fixed manufacturing overhead resides in inventory when units remain unsold. The potential result is positive operating income when the number of units sold is less than the break-even point. Okay, and explaining change in net operating income. Actually, this explanation I've already told you. So variable costing income is only affected by change in unit sales. It is not affected by the number of units produced. As a general rule, when sales go up, net operating income goes up and vice versa. So in a variable costing income statement, so a variable costing income is only affected by change in unit sales. Yes, why? Because not affected by the number of units produced, because it does not include fixed manufacturing overhead in the number of units produced in the unit product cost. Absorption costing income is influenced by change in unit sales and units of production, because in absorption costing, fixed manufacturing overheads are included into the unit product cost, and net operating income can be increased simply by producing more units, even if those units are not sold. Okay, now let's look at supporting decision making. Variable costing correctly identifies the additional variable costs incurred to make one more unit. It also emphasizes the impact of total fixed costs on profit. As do you remember, in variable costing income statement, the full amount of fixed manufacturing overhead goes to the income statement. And variable costing income statement is useful for managers because they must know how much contribution they should generate to fully cover all fixed costs, and as I said, to be truly profitable. And because absorption costing assigns fixed manufacturing overhead costs to units produced, it gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it is not. You remember, fixed manufacturing overhead, these are not variable manufacturing overhead. They seem to be, it seems that as if fixed manufacturing are variable, but in fact, fixed manufacturing overheads are not variable. The result can be inappropriate pricing decisions and product discontinuation decisions. Right, so it seems that as if this manufacturing are variable, fixed manufacturing. And if it seems like that, then some product that was producing will be discontinued or will be dropped out of the production. So the wrong decisions can be made based on absorption costing system. Okay, now we'll look at segmented income statement that differentiate traceable fixed cost and common fixed cost, and use it to make decisions. So decentralization and segment reporting. So if there is a big company and, for example, a transnational company, it has an office, a headquarter, a main office, which is, for example, in USA, and it has several divisions. So each division may be represented as a segment, a separate segment. And why decentralization? We're talking about decentralization. It means that some decisions are made by the managers of the segment. So not only the headquarter managers make decisions regarding all divisions, but each division's manager has some power or flexibility or power to make decisions regarding their segment. So what is a segment actually? Is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. So segment may be a sales territory, it may be a separate division in separate branch of a transnational corporation or segments of this corporation. It may be an individual store, it may be a service center. So this is a segment of a business. And what are the keys to segmented income statements? There are two keys to build segmented income statement. A contribution format income statement should be used because it separates fixed from variable costs and it enables the calculation of a contribution margin, and traceable fixed costs should be separated from common fixed costs to enable the calculation of segment margin. So what are the traceable fixed costs? Each segment has its own fixed cost. So this cost that can be easily traced or linked to a separate segment, to the segment, are called traceable fixed costs. Common fixed cost is a cost which cannot be easily traced to the segment. So let's look at the examples. Traceable fixed costs arise because of the existence of a particular segment and would disappear over time if segment itself disappears. So if it's easily traceable to segment, any segment, then if segment disappears, or this, if a division, let's say a division will be closed of a transnational corporation, a division which is in Uzbekistan, for example, if the division will be closed, then this traceable fixed will totally disappear. Examples of traceable fixed costs. Salary of the Fritos product manager at PepsiCo is a traceable fixed cost of the Fritos business segment. So if transnational corporation Pepsi Cola has a branch here, we will call that branch a segment in Uzbekistan. So the salary of the manager of the branch in Uzbekistan will be what? Traceable fixed cost. Traceable. If we close that branch of Pepsi Cola in Uzbekistan, so we will sack the manager, and what? The traceable fixed cost will disappear, fully disappear. And another example, the maintenance cost for the building in which Boeing 747s are assembled is a traceable fixed cost of 747 business segment of Boeing. So as you know, a Boeing company has also different branch or segments, or and it has a segment where the 747 Boeings are assembled, actually are made, right? And the maintenance cost for the building of this assembly department. So assembly department, this assembly factory has its own maintenance cost. If Boeing closes this assembly department or assembly factory, that all maintenance costs will disappear. So if this kind of cost disappear with a branch totally, with a segment, then these costs are called traceable fixed costs. Common costs. These costs arise because of the overall operation of the company and would not disappear if any particular segment were eliminated. For example, the salary of the chief executive officer of General Motors is a common fixed cost of the various divisions of General Motors. So you know General Motors has different branches in different countries. So even in Uzbekistan, we have General Motors automobile company. And the salary of Chief Executive Office of General Motors, the salary of CEO in the USA, of General Motors company in the USA, and the salary of the CEO is regarded as a common fixed cost. even if the General Motors company, the branch will be closed in Uzbekistan, so the salary of the CEO still will exist. So a company still has to pay to CEO of General Motors. So got the point, common fixed cost and traceable fixed cost. Rajma, Salma. Okay, segment margin. So what is a segment margin? Segment margin which is computed by subtracting traceable fixed cost of a segment from its contribution margin. Is a best gauge of the long-run profitability of the segment. So a best measure, the gauge is the measure of long-run profitability of a segment. So traceable and common costs. So fixed cost, traceable cost, common cost. And don't allocate common cost to segments. So let's look at the example. We have Weber Incorporation. Company has two divisions, computer division and television division. And let's look at the income statement. Okay, so the company has here at the television division. Okay, so we have a computer division and television division, and we have here television division's income statement. So income statement, contribution margin format, television division. So as you see, it has sales, it has variable cost of goods sold, COGS, it's cost of goods sold, 120, minus other variable costs. So first we subtract from sales revenue, we subtract all variable costs, and we get contribution margin. And from contribution margin, we subtract traceable fixed costs. These are fixed costs which are related only to this division. And we get division segment margin. Okay, and cost of goods sold consists of variable manufacturing, we know, and fixed and variable costs are listed in separate sections. Okay. So this approach uses segmented levels of segment contribution margin format. And now let's look at contribution margin is computed by taking sales minus variable cost, and segment margin is television's contribution to profit. Let's look at segments. So this is the company. It has two divisions, television division and computer division. So how to calculate, this is income statement for the company as a total. So sales revenue of each company. So we add up sales revenue of each company, variable expenses. So television division variable expense plus computer division variable expense. We have for the company total variable expense 230. Then contribution margin we calculate for each division. So how for the company as a total, we add up contribution margin of both divisions, and now it's 270. And each company has its traceable fixed costs. If we add up traceable fixed cost, we calculate for the company as a total, and division margin. Division margin for each cost, for each company, sorry, for each division. If we add up, we'll get a total company division margin. Okay, and here on this table, we have common expenses. So we have division margin and we have common expenses. And as you see, common expenses are not traced to each division. Common expenses we subtract from the total division margin, from the total company's margin. And what is it? Total net operating income? It's 75,000. And as you see, fixed costs should not be common expenses, or common fixed expenses should not be allocated to the division. These expenses would remain even if one of the divisions were eliminated. Okay, now let's do, we will continue looking at this segmented income statement when the company has different or various segments. Let's now look at, I will open another demonstration. How to calculate it? So we have here in the right corner, you see that this table. So units in beginning inventory 0, units produced 50,000, units sold 49,000 units. Units in ending inventory 1,000. So in ending inventory we have 1,000 units. So actually tell me what happens to the net profit on the variable and absorption. What do you think? Which of the profits will be higher, on the absorption costing or on the variable costing? Just looking at the inventory, beginning and ending. What do you think?
Absorption costing, I guess.
Yes. Oh, on the absorption, net operating income will be higher or lower?
Will be lower.
On the absorption, Salma. So what happens to inventory? Inventory increases or decreases? Increases. When inventory increases, it means that ending inventory is higher than beginning inventory, right? And on the absorption costing, we are just analyzing situation, yeah? On the absorption costing, these 1,000 units have a portion of fixed manufacturing overheads. And now calculate what is that portion of fixed manufacturing overhead that resides in these 1,000 units of ending inventory. So what is the amount of this fixed manufacturing in dollars? Can you calculate this? What do you think? How do we calculate? Fabrianti, Salma? So what is the total amount of fixed manufacturing overhead given in our table?
800,000.
100,000.
Yes, 800,000. This is total fixed manufacturing overhead. How many units have been produced? Not sold, produced.
50,000.
50,000.
Yes. Okay. So what is the fixed manufacturing overhead per unit produced? What should we do?
16.
Yes. How do you know, Fabrianti?
I divide fixed manufacturing overhead divided by unit produced.
Exactly. So $16, right? So 800,000 we divide by 50,000. $16 of manufacturing overhead resides in each of these 1,000 units. So got the point? Each one of the 1,000 units has $16 of manufacturing overhead under absorption costing. Under absorption costing, we include direct labor, direct material, variable manufacturing overhead, and fixed manufacturing overheads into the unit product cost. So 16,000 resides here in ending inventory, right? Very good. Now, prepare an income statement for the year using variable costing. What is the amount of difference in net operating income between the two costing methods? Okay, let's prepare income statement on the variable costing system. So how should we do that? The first line in the income statement starts with what? Starts with sales, right?
Right.
So sales revenue. We are on the variable costing system, right? So we have sales revenue. Then sales revenue is the same. Cost of goods sold. Let's calculate cost of goods sold on the variable costing. So which costs will be included into each unit of the product produced? So what do you think? Which units should I include? And the variable cost per unit into each unit.
Direct material.
Direct material, good.
Direct
Labor.
Plus direct labor.
Manufacturing overhead.
Plus
Manufacturing overhead. Variable manufacturing overhead.
Yeah, again, tell me please. Direct material.
Direct materials, direct labor, and variable manufacturing overhead.
Yes, exactly. So only in the unit product cost, we include direct material plus direct labor plus variable manufacturing overhead. So this is product cost. We do not include variable selling and administrative in the product cost. Only these three goes into the unit product cost. So 55 plus 25 plus 12, right? So 92. And cost of goods sold. How do we calculate cost of goods sold for variable costing? So 92 we must multiply by what? By which number?
Unit sold.
Exactly.
Unit
Unit
sold.
sold. Unit sold. Yes, by 49,000. Okay, very good. And then we must subtract this amount from sales revenue, right? And then we get what? Gross margin, or how do we call? Sales minus cost of goods sold equal to Fabrianti?
Contribution
Yeah,
margin.
exactly, contribution. Yes, but before going to contribution margin, we forgot about selling and variable, right? So sales minus cost of goods sold minus variable selling and administrative. So what is the amount of variable selling and administrative expenses? Tell me. So what should we do with this $15? It's per unit. We multiply by what? $15 we multiply by
unit sold.
Yes, exactly, by unit sold, by 49,000. Okay, now sales minus cost of goods sold minus variable selling and administrative, and then we get contribution margin. And from contribution margin, we subtract what? All fixed costs. So what should we subtract?
Fixed manufacturing overhead.
Yes, fixed manufacturing, 800,000, and
Fixed selling and administrative.
fixed selling and administrating. Yes, very good. Okay, now let's look at this slide. Determine how much of the ending inventory consists of fixed cost. So you have calculated correctly. 1,000 of ending inventory, we multiplied by $16 fixed manufacturing overhead per unit. And fixed manufacturing overhead in ending inventory, which resides or sits or included in ending inventory, 16. Now prepare income statement, variable contribution format income statement, right? Using variable costing. So sales revenue is the same. Variable cost of goods sold, you have calculated correctly. So $92 we multiply by the number of units sold, 49,000. Then minus variable selling and administrative, $15 per unit, we multiply by number of units sold. Okay, and we find out the total variable cost. If we subtract total variable cost from sales revenue, we get contribution margin. Then contribution margin minus fixed manufacturing, all fixed manufacturing and fixed selling and administrative. And then we get net operating income. So you see the net operating income is lower than on the variable costing than on the absorption costing. Why it is lower? Net operating income on the variable costing is 957. And the absorption is 973. Why this difference exists?
Because the inventory is increased.
Yeah, because of
Inventory.
Because in the inventory, 16,000 of fixed cost stays in inventory, ending inventory, right? And we are not selling this ending inventory. And that's why we do not include this inventory in the cost of goods sold, right? So this inventory still resides. So this 16,000 of fixed manufacturing resides in inventory. When this inventory will be sold, then this 16,000 will be included into the income statement, into the cost of goods sold, will be here in the cost of goods sold. But as far as this inventory is not sold still, that's why variable costing profit is lower than absorption costing profit, exactly by 16,000, right? By how much it is lower? So net operating income under absorption costing, 973,000 minus 957. So it is exactly 16,000. So by this amount, by 16,000, net operating income is lower on the variable costing. Okay, let's calculate fixed manufacturing overhead 800,000. How much of this fixed manufacturing overhead is included in the cost of goods sold? So $16, if we multiply $16 this fixed manufacturing overhead per unit, if we multiply by the number of units sold by 49,000, so 784 only minus 800, so exactly 16,000. Okay, so out of fixed manufacturing overhead, out of this 800,000, only the portion of fixed manufacturing overhead is included in the cost of goods sold here under absorption costing. And what is this amount? So 16, if we multiply by the number of units sold, 49,000, so 784,000 of fixed manufacturing overhead has been included in the cost of goods sold on the absorption costing. But on the variable costing, you see, on the variable costing system, the total amount of fixed manufacturing overhead is subtracted from the gross contribution margin. And that's why the amount of net operating income is lower than on the absorption. Okay, now let's do, this break-even point. Let's do this exercise. So Relay company segments its business into two regions, East and West. The company prepared. How much time do we have? Until 4? Farah, how much time do we have? We started
maybe remaining 30 minutes.
30 minutes, right?
Yes.
Okay. Okay, so let's look at this example. So this company has two segments, East and West segment, and each of them has sales revenue, has variable expenses, contribution margin, traceable fixed cost, segment margin. So how do we calculate for the company, total for the company? So sales revenue, if we add up 600,000 plus 450,000, so for the company total, it's 1,050,000 of sales revenue. Variable expenses, we calculate in the same way. Variable expense of East plus variable expense of West. So this variable expense total for the company. Contribution margin also calculated for each division or segment. And if we add up these two contribution margins of each division, we end up with total contribution margin. Traceable fixed costs. These costs are traced or incurred by division only. Okay, let's add up traceable fixed costs and we get for the total for the company. And contribution margin minus traceable fixed cost, segment margin. So for segment margin also we add up two values. We get segment margin for the total for the company. And common fixed cost. Common fixed cost we not include, or we do not include, we don't trace to each division. So this common fixed cost. We subtract from segment margin common fixed cost, and what is net operating income for the company as a total is 247,000. Now compute the company-wide break-even point in dollar sales. Oh, sorry. So how can we compute this? Do you remember? Compute the company-wide break-even point in dollar sales.
Fixed unit divided to contribution margin.
Yeah. Contribution margin ratio, right? Yes. When we asked in dollar sales, so we need fixed cost, total fixed cost divided by contribution margin ratio, right? So what is the contribution margin ratio total? Let's compute this for the company. Contribution margin ratio. Let's say total for the company. So what should I do with these values? How can I calculate?
Contribution margin divided by
selling.
Yeah, very good. So 55,000 I divide by, let's divide.
Total sales.
Yeah. But by sales revenue, right? So what is contribution margin?
On 0.5 contribution margin ratio.
Okay, let's divide 1,050,000. Let's say contribution margin ratio is 0.529. Let's round it. Okay, and now let's calculate break-even. Break-even in dollars. Let's write down in dollars. In dollar sales. For the entire. Okay, so what is the fixed cost, the total fixed cost for the company? Lady Salma?
185,000.
Yes, it is fixed common, and we also have fixed traceable, right? So how to calculate for the company? Fixed traceable plus common fixed expenses. And now what should I do? Divide by contribution margin ratio, 0.529. Okay, so what is the break-even point in dollar sales?
$582.
582.
So 582. 82,231. Let's round it, right? Okay, and very good. Now for one, was requirement 1. For requirement 2, can you calculate quickly and tell me the result? So compute the break-even point in dollar sales for the East region separately. Only for East region.
Um, 113,000.
Okay. How do you know this? How have you calculated?
Calculate by fixed cost dividing by contribution margin ratio. So the 60,000 dividing by 1.529.
Okay. Let's who is telling this, Salma or Fabrianti? Okay. So contribution margin now for East. Okay, East. So how to calculate contribution margin for East?
240,000.
240. Yes, we divide.
Divided by 100,000.
600,000.
Sorry.
Equal to
0.4.
0.4. Okay, very good. And now a break-even point in dollars. Break-even. Break-even in dollars for this segment, for this division. Fabrianti, Rachma, who was telling?
Break-even point is fixed cost.
Yes. What is the fixed? What is the fixed cost for East?
60,000.
Yes, very good. 60,000. We divide by 0.4 contribution margin ratio. And what is that amount in dollars?
150,000.
Yes, 150,000. Very good. Okay, excellent. And now let's calculate separately for for West Division? Salma, now you tell.
315
315,000.
divided by 450,000.
Very good. 450,000 sales revenue.
0.7.
Yeah, very good.
Yeah,
0.7. 0.7 contribution margin ratio. And then a break even. Now break even in dollar. In dollar, sales.
63,000 divided by
92,000.
0.7.
So fixed cost, 53
Yeah.
traceable fixed cost. We divide by
0.
by what, Salma? 0.7.
0.7.
And what is the amount?
90,000.
90,000. Yes, very good. So what does it mean? Who can explain what is that 90,000? So we know 90,000. So how can you explain what should company do with this 90,000? So what is it break even in sale? When we say break even point in dollar sales, what does it mean that 90,000? Who can explain? Salma, Fabriante, Navita, active students, Sarah, other students, why you are silent? Salma, Fabriante, what does it mean 90,000?
Okay, I'll try. So, the manager need break even point. It is 90,000 to get over 90,000 to get profit.
Yes. Yes. So what is this 90? So at least $90,000 generate sales revenue. So at least for it must sell number of units to have that 90,000 sales revenue to cover fixed costs, right? To have that to cover fixed costs. When company generates 90,000 in sales revenue, so the profit will be 0 because it's a break-even point. So this 90,000 sales revenue minus variable cost of goods sold, variable, right, equals to contribution margin, and that contribution margin will be exactly equal to cover fixed cost. So when company generates 90,000 of sales revenue, the profit will be 0. And the manager should know if the sales increase, if the manager increases sales more than $90,000, then the company will make a profit. If sales revenue will be less than 90,000, then the company will make loss. So got the point?
Okay.
90,000 is just enough to cover variable cost, to cover fixed cost, and profit 0. So this is break-even point when profit is 0. right? So manager should know this point, this how to say this boundary, the boundaries of if it goes beyond lower than 90, it's bad for the company. If it makes a manager makes more than 90,000 of sales revenue, then it is good for the company. Okay, so this is the meaning of break-even point in dollar sales, and we also know break-even point in units. How to calculate in units? Just tell me the formula. When we need to know how many units to produce in units. Fabriante, break-even point in units?
Cost divided by contribution margin.
Yes, exactly. And we will know how many units we must produce in order to have to cover fixed costs and to have zero profit. If we produce more than break-even point, that is good for the company. Company will make profit. If we produce less than break-even point, then again, company will make losses. So it's kind of a line. So a line, so beyond which we should not go. If we go beyond that, if we make lower than that, then company will make losses. Okay, and this is the computation of this. So everything, you have done everything correctly. And what we have here, next exercise. Let's try to do this. Cheetah Company manufactures and sells a single product. The following costs were incurred during the company's first year of operations. So variable cost per unit, direct material, direct labor, variable manufacturing overheads, variable selling and administrative. Fixed cost, we are given fixed manufacturing, fixed selling and administrative. Now, during the year, the company produced 40,000 units and sold 38. So what happens to the inventory? Just quickly look at this. Has inventory increased or decreased?
Increase.
Increased, yes. So when it increases, you should keep in mind that absorption costing profit must be greater, must be higher than variable costing profit if inventory increases. So as far as produced 40, sold 38, how many units and in the ending inventory? Salma, how many units in ending?
2,000.
2,000. Yeah, so the beginning was 0, ending 2,000. So inventory increased. The selling price of the company's product is $80 per unit. So this is the selling price. You need to know the selling price in order to calculate sales revenue. Okay, assume that the company uses absorption costing system. Compute the unit product cost. So tell me, what is the unit product cost under absorption costing? So which type of cost I should include? Enter the unit product cost. Enter the cost of each unit.
Direct materials.
Yeah, very good. Direct materials 8, then plus
Direct labor.
12, very good.
Variable
Variable
manufacturing overhead.
Very good, 6.
and fixed manufacturing overhead.
Okay, and how fixed manufacturing overhead? This is a total amount, 440. But I must know per unit. So what is the fixed manufacturing per unit? Fabrianti, who is telling? Nurul, is it you? How should I calculate fixed manufacturing overhead per unit?
11. That's right.
How do you know, Fabrianti?
Fixed manufacturing overhead divided by the unit produced.
Yes, exactly. Very good. 440,000. I divide by number of units produced, not sold, produced. 40,000 units have been produced. So if I divide total by 40,000, how much is gonna be, Fabrianti?
11.
11. Okay, now let's calculate unit product cost under absorption. So direct material 8 plus direct labor 12 plus variable manufacturing 6 plus fixed manufacturing overhead per unit 11. So what is the total?
37.
$37. Yes, very good. It's a cost per unit, unit product cost. Now prepare an income statement for the year under absorption costing. So first line starts with sales revenue. How do we know sales revenue?
Selling price multiplied by unit sold.
Yeah, exactly. So what should I do, Fabrianti? Selling price 80 multiplied by 38,000, right? So let's multiply. What is the sales revenue? Do you have calculators in front of you? So what is, Fabrianti, what is the sales revenue value?
3,014,000.
Yes, very good. So for sales revenue, we have data. Now, cost of goods sold. How do I know cost of goods sold? The second line, cost of goods sold. How should I calculate it? Fabrianti, Salma? Other students are just silent. Reni, Nurin, Amadea, Yubila. Maybe I do not pronounce correctly, but I'm trying. Sarah. So cost of goods sold. What is the cost per unit under absorption costing? We have just calculated. Fabrianti, what is the cost under absorption costing? Do you remember we calculated direct materials plus direct labor plus manufacturing overheads plus $11 of fixed manufacturing overhead. The total cost of each unit, $37. The cost of goods sold, $37. I must multiply by which number?
38,000.
Exactly, 38, number of units sold. And cost of goods sold equals to 1,406,000. If I sales revenue minus cost of goods sold in absorption costing equals to what? Gross margin or contribution margin?
Contribution margin.
Under absorption costing, Sarah, under absorption, how do we call that value? Gross margin, yes. And gross margin then minus variable selling administrative, and fixed selling and administrative. Okay, assume that company uses variable costing. In variable costing, what is unit product cost? Compute the unit product cost. Sarah, tell me, how do which types of cost I should include in the unit product cost if it's variable costing? Only variable costs should be included into the unit product cost.
Direct material.
Yes, very good. Direct material.
Direct
Plus
Labor.
direct labor.
Yes. Variable
Plus,
manufacturing overhead.
Manufacturing overhead.
yes, plus 6 variable manufacturing overhead, right? We don't include fixed, only variable. And we don't include variable selling and administrative. These are not product cost. So we just include direct material, direct labor, and variable manufacturing overhead. And the total amount is, what is the unit product cost?
26.
26. Very good. Now prepare an income statement again. So the sales revenue will be the same, right? We have calculated sales revenue. How should we calculate cost of goods sold? Salma, tell me.
Unit.
So what is the cost per unit? What is the cost?
Cost per unit.
26, right?
Yeah, 26 multiplied by
We multiply by what?
38,000.
38. Very good. And then we also must subtract which costs we must subtract, Salman, in variable costing. To arrive at contribution margin. So we must arrive at contribution margin. But before arriving, so sales revenue minus cost of goods sold minus what? Do you remember? Variable selling and administrative expenses. So how much? $5 per unit I must multiply by which amount? Units produced or units sold?
Unit sold.
Exactly, units sold, 38,000. It's 190,000. Then sales revenue minus cost of goods sold minus variable selling and administrative equal to contribution margin. And then contribution margin minus total fixed manufacturing and fixed selling and administrative. And then we get net profit. And tell me just, so I will show the calculation, the solution, but tell me which profit will be higher, on the absorption or on the variable costing? Just tell me again. At the beginning, Salma of Aprianti told. So which profit will be higher?
The absorption will be higher.
Yes, exactly. On the absorption, because inventory increases, beginning 0, ending 2000. So it increases. Okay, let's look now at the solution. So a company uses absorption on the absorption costing, direct materials plus direct labor plus variable manufacturers plus 11 fixed manufacturing. Unit product cost 37. Sales revenue. So how we calculate it? So number of units sold 38,000, we multiplied by selling price. Cost of goods sold, so $37, we multiplied by 38,000 units sold. equals to gross margin minus selling and administrative. Selling and administrative. Selling and administrative total. Selling and administrative, it is 260. But here, selling and administrative 450. How do we arrive at this value? Fabrianti, what do you think? Selling and administrative 450. How do we know that it is 450? Because fixed selling and administrative 260. But we must make it 460. Fabrianti, what do you think? Total selling and administrative. Look at this. Can you see I'm typing? 260,000 plus. What should I add up here? I'm talking about selling and administrative. So total selling and administrative costs. Administrative costs equal to 260,000. You see that is fixed selling and plus variable selling. So if variable $5 per unit, so $5 I multiply by number of units sold. So how much is total? In total it's gonna be? Can you calculate?
450,000.
Yes, exactly, 450,000. And you see in absorption costing, selling and administrative here, total 450. Because we do not divide into variable and fixed part in absorption costing. We just subtract the total amount, 450 selling and administrative, and we arrive at net operating income. Okay, using variable costing. So what is a unit cost? Direct material plus direct labor plus variable manufacturing overhead. It equals variable cost per unit, 26. So sales revenue, now income statement. Sales revenue is the same. Variable cost of goods sold, how do we know this? $26, we multiply by 38,000 units sold. And we subtract also variable selling expenses. So $5 we multiplied by 38,000 units sold. And total variable expenses, we subtract from sales revenue, we get contribution margin. And in contribution margin, the total amount of fixed manufacturing we subtract and fixed selling and administrative expenses. And net operating income, you see, is lower than in absorption costing system. So what is the difference? How do we know the difference? By how much it is lower in variable costing than in under absorption costing system? Who can tell me? So what is the unit fixed cost per unit? 440 we divide by 40,000 units equal to, it was 11, right? 11. So $11 is fixed cost per unit. Fixed cost per unit. How many units have been left in inventory? How many units we have in inventory? We have 2,000 units.
Yes.
Yes, let's multiply by 11, right? So with this fixed manufacturing overhead per unit, 11. Fixed manufacturing, overhead per unit. So this $11 resides in each of 2,000 units. So 2,000 units we multiply by 11, right? So how much it's gonna be? 22,000. 22,000. So this is a difference that must be between absorption costing profit and a variable costing profit. Okay, so let's look at absorption costing profit is higher and variable costing profit is lower. So 1,1,084 minus 22,000, and we arrive at this amount, 1,162,000, sorry. So exactly by this amount, $22, absorption costing will be higher, absorption costing profit will be higher, and by this amount, absorption variable costing profit will be lower. Profit or income, net operating income, will be lower. So got the point why the difference exists between operating incomes under absorption and variable costing systems. Okay, do you have any questions? I will give you some more exercises to do again at home. So you will do exercises at home. And I will send out this presentation, and please read chapter 7 from the book Brewer and Garrison and Norin, Introduction to Managerial Accounting, from the Brewer and Garrison's book, chapter 7. You have that electronic version, so please read. If you have any question, so just let me know via Telegram channel. Any questions related to this topic? To this chapter? Any questions? So we have looked at the unit product cost calculated under two methods, and we considered or analyzed income statements under two methods, under absorption costing and variable costing methods. Okay, and we actually examined why there is a difference between net operating incomes under two methods, under absorption costing and variable costing method. So, any questions, students?
Not yet, Miss.
No, Miss.
Are you sure that everything is clear? What do you think? Which of the income statements, contribution format or absorption costing or traditional format income statement is more useful to managers? Which of them? Contribution format or under variable costing system income statement or under absorption costing income statement? Which one is more useful for managers? Rachma, what do you think? Fabrianti, Salma?
I don't know, Miss. Is it depend on inventory last year?
Yes, Salma, can you repeat? Because of bad internet connection, I could not understand your words. Which one is more useful of income statements? Under variable or absorption costing? Prepared under variable or absorption costing? What do you think? Fabrianti, Rachma, Salma, you're telling something. So for managers, of course, this format, contribution format income statement or under variable costing is more useful because they know how variable costs change. If they produce one more unit, if they sell one more unit, how contribution margin will be changing. And if they look at contribution margin, if it is enough to cover fixed costs, if it's enough to cover fixed costs, and why it's called contribution margin? Because this value, 1,862,000, contributes towards, after covering fixed costs, it contributes towards profit, net operating profit. So this under variable costing system is more useful for managers for internal use. When they see how costs behave, how variable costs change, whether contribution margin is enough to cover fixed cost. If it's more than fixed cost, then the company will make profit, net operating profit. If it's less than contribution, if contribution margin is less than fixed costs to cover fixed costs, then it must sell more units. It should increase sales revenue to cover fixed costs and to have some profit, some income. That's why this contribution format or income statement prepared on the variable costing system is more useful for managers, and it is used by managers for internal use. To submit, for example, for tax authorities, to submit to outside investors, to shareholders. This traditional format, which is prepared under absorption costing, is quite enough. So usually when company presents its results to public, submits its financial statements to public, they represented in the traditional format, this one, traditional format. But for managers, this contribution format is much more important, vital, and useful. Okay, so got the point. Okay, students, we'll meet next Friday at the same time. And I will send presentation and some more exercises to work at home. Okay? So if you have some questions, don't hesitate, please, to ask me.
Okay.
Yeah,
Okay,
Miss.
thank you for joining and take care. Have a good weekend and we'll meet next week.
Thank you, ma'am.
Okay, thank you, Miss. Take care, you too.
Thank you,
Have a
bye.
good
Thank you
week.
for active participation. Okay, see you, bye.
See you.
See you, Miss.
See you.